I'm honored to be here tonight, and Dean Sunni, thank you very much. And it's my pleasure to be the kickoff speaker for what I think will be a very invigorating day, talking about what led this country's financial system to the verge of collapse, what has left our economy in tatters, and what we need to do to avoid the mistakes of the past and build a very different kind of financial system and economy that can sustain this country in the years ahead. So, Bill, thank you very, very much for asking me to come here tonight. By the way, your introduction was better than you'd find on Google, Bill, because the thing about Google is they can say anything, but I appreciate those very kind words. And I just want to say that I'm a big fan of Bill Black. And I think the dean was right. He's known here, he's known across the country, he's known across the world for his work in financial matters, particularly financial fraud. And I want to thank Bill for the advice, the counsel, the information, and really the support he gave all of us as we undertook this job on behalf of the nation. It's a little ironic that I would be giving this talk tonight in a courtroom, a venue which is almost wholly unfamiliar to the people who drove this financial crisis in this country, but here we are. What I'm going to do tonight is speak with you about really three things. Hopefully briefly enough that we can engage in a good round of questions. First of all, I am going to talk about the work of the commission, but tomorrow morning, you're going to have the pleasure of hearing from Wendy Edelberg, who is our executive director, who's going to talk in detail about how we did our work, which had a lot to do with the substance of our review and the conclusions we came to. You'll also be hearing tomorrow from Chris Seifer, our chief investigator, and I just want to say I thought they did an extraordinary job for this country. And, they worked 15, 16, 17-hour days relentlessly for a year and a half. But I want to talk a little bit about our work and our findings. I want to talk about, secondly, where we stand today, 3 years after the crisis completely unfurled across this country and across the globe. It would be a mistake to say 3 years after the crisis because we find ourselves still in its grips today. And then finally, I'd like to make some remarks about where we need to go from here to move past this crisis so that we can not only rebuild but remake our financial system and economy so it is one that truly provides sustained growth, wealth, and opportunity for a broad swath of our society. In starting tonight, I want to make a couple of personal observations about the journey that I undertook along with fellow commissioners and staff. When I accepted this appointment, and by the way, I was deceived completely. I was told it would take about a third to one half of my time, and I think Wendy will tell you, even today in November, we were a year ago, several weeks out from finishing our report, working 18 hours days. It was a full-scale commitment, but when I accepted this appointment in July of 2009, I did it with some belief that I had some reasonable understanding of the financial system of this country. After all, I'd been in the private sector for 20 years. As Bill mentioned, I'd been in real estate. I'd been in finance. I had, on my own accord with my partners, raised $1 billion plus in equity and debt. I had been treasurer of the state of California for 8 years, and I'd sat on the board of the two largest pension funds in America with $400 billion in assets. But I will tell you that this was a journey of extraordinary revelation. And along the way, I was surprised, I was fascinated, and I was deeply disturbed at what I learned. At times, I felt like I had walked in my local community bank, I'd opened the wrong door, and I'd seen a room as big as the floor at the New York casino. I had no sense of the level of gambling and risk that was being taken in our financial system. And I will tell you that unlike Claude Rains in Casablanca, I was truly shocked. The second thing I want to say is that for all my years in civic life, half my career has been in the private sector, half in the public sector, but I'm not by any means a political naive. I had run 4 times statewide in the state of California. I'd run for governor of the state of California. I was taken aback at the raw exercise of power by the financial institutions of this country. I had some sense, but not a full sense, of the extent to which they wield an enormous power and the crudity with which they exercise that power. And I left Washington more concerned than ever about the sheer power of money as it affects decision-making and public policy in our country. And the final thing I want to say on a personal note is we did much of our work, obviously, in Washington. We held hearings there. We held them in New York. But we also traveled to communities like Bakersfield, California, where unemployment's near 20%, foreclosures among the highest in the country. We went to my hometown of Sacramento, which again has one of the highest foreclosure rates in the country, an effective unemployment rate of 15% plus, Miami. And as we went across this country, we met hundreds of people whose aspirations had been crushed by what had occurred in this country. And there was a real sense that coming out of this crisis, and we know this, I think, from academic work, that the climb out of a financial crisis is long, hard, and arduous, and there are millions of Americans who are questioning today whether they can climb out of the rubble created by this crisis. And there was this really fascinating dichotomy, if you looked in the wake of the crisis, between the lack of correlation, in a sense, between who drove this crisis and who has paid the price. It's as if a earthquake had hit and the gleaming skyscrapers at the epicenter of that earthquake were left untouched, and there was rubble strewn all over the place. So we did our work, as Bill said, with the hope that we could make some contribution to the body of knowledge that would lead this country to be less apt to go down, once again, the route of recklessness and risk that brought us to where we are today. It's fair to say that this crisis is by no means over. As we gather here tonight, 24 million Americans are unemployed, are underemployed, stop looking for work without hope of getting it. American households have lost $9 trillion in wealth since the onset of this crisis. 4 million families have lost their homes to foreclosures, and the estimates are that that may go as high as 8 to 13 million before all of this is over. We haven't come out of the crisis, and the fact is, as I said, that the history of financial crises is they tend to last a decade. Now, it was important, as Bill said, for us to do our work in a way that we could impart to the American people a historical account of what happened. We were not charged with rendering recommendations about how to avoid the next crisis, but I think we were keenly aware of the fact that it was fundamentally important to write history accurately so that it could endure and the lessons could be learned. And so our role really, I think as we saw it, was to expose facts, to identify responsibility, to unravel myths. And it was our attempt in doing this report to record history, not to rewrite it, but also to do our level best to make sure it would not be rewritten. A little bit about our inquiry. Wendy will talk about it more tomorrow. We were charged by the Congress of the United States and by the law that President Obama signed with examining the causes of the financial and economic crisis that beset this nation. We were also called upon to examine the collapse of the major financial institutions that collapsed in this country or would have collapsed but for the extraordinary assistance given by the taxpayers of this country. And finally, we were asked that if in the course of our work we came upon information that would lead us to believe that there were potential violations of law, that we were to refer those cases to the Attorney General of the United States or other appropriate legal authorities, which in fact we did. In the course of our investigation, we examined millions of pages of documents. We interviewed over 700 witnesses. We held 19 days of public hearings throughout this country. And as we began our work, so much of the questioning in this country centered around whether or not the decision to bail out major financial institutions was the right decision, whether we should have bailed out too big to fail institutions or not, and that debate still rages in this country today. But I think for us, the central question was not so much that, because that in fact was a fact of history, but the real question was for us to ask and answer this central question: how did it come to be that in the fall of 2008, the country appeared to face only two stark and painful choices? One was to allow the total collapse of our financial system, or alternatively, to inject trillions of dollars of taxpayer money into that system through 24 various programs and still have 9 million Americans lose their jobs, 4 million homeowners lose their homes, and have our economy left in tatters. In doing our work, as I said, our main focus was to write the historical record, and notwithstanding the political attacks that have been made on our conclusion, I think what I am proudest of, and I know that the people on the staff and the commissioners who adopted this report feel the same, is we are now some 10 months after we released our report. And while there have been many assaults from ideologues on this report, as of today, not one fact of this report has been successfully challenged from a point of accuracy. And in the end of the day, facts are very powerful. And this report is truthful in terms of what happened to this country in the years leading up to and during the crisis. But we were called upon to render our conclusions about main causes. And again, Wendy and I will talk about this some tomorrow, but let me at least briefly talk about the main findings of our report. First and foremost, we found that this crisis was avoidable. And I say that simply and clearly because the reigning narrative that emanated out of Washington and Wall Street at the time we began our work was that this was a collision of forces bigger than anyone. This was a perfect storm, something that could not have been avoided, a once-in-a-lifetime extraordinary event. But in fact, as we looked at the facts, it's evident that all along the way there were warning signs and there was human action and inaction, not risk models gone awry, that led to this crisis. And I must say bluntly that the CEOs of the major financial institutions and the public leaders who were the stewards of our financial system let us down, and their miss was a big one, not a mere stumble. And for those who say no one could have seen it coming, let me just say loudly and clearly that all along the way, there were flashing red lights and warning signs. One need only look at what was happening in the housing market, the unsustainable rise in housing prices, the warnings from the FBI beginning in 2004 about an epidemic of mortgage fraud, which if it was left unchecked could leave the country with losses bigger than the savings and loan crisis. The widespread reports of predatory and egregious lending practices that began to metastasize in this country in the late 1990s. The dramatic growth of risky trading practices that converted many of our main financial institutions from institutions which lent capital for the building of enterprises to institutions largely focused on trading for their own account and taking big bets in the marketplace. And of course, there was that very small matter of the creation of $13 trillion of mortgage securities and the doubling of mortgage debt in this country within 1 decade. Probably the prime example of the human and political and policy failures that led us into the abyss was what happened, or more, I think accurately, did not happen at the Federal Reserve under Alan Greenspan. If you look at what happened to the Federal Reserve, as early as 2001, the Federal Reserve was confronted with information about the nature of lending practices beginning to occur in this country. They had a debate at the Federal Reserve about curbing out-of-control subprime lending. At the end of that debate, they adopted a set of rules which they thought would control 38% of subprime lending in the marketplace. In fact, the rules were so weak that they controlled 1%. By 2005, there were all kinds of economists, pieces of information in front of the Federal Reserve, laying out in stark detail what was happening in the mortgage markets. But even from that point on, it took a full year for the federal regulatory agencies to issue voluntary guidance warning banks about lending practices. And it wasn't until July of 2008, after the cake was baked, the economy was in full-fledged collapse, that the Federal Reserve finally adopted a rule that consumer advocates had been urging on them for a decade, which is you can't make a loan to someone who cannot afford to pay that loan back. When we queried Alan Greenspan about his tenure at the Federal Reserve, he commented that he had been 70% right and 30% wrong. To which I reflected the fact that the captain of the Titanic had been right 99% of the time and wrong only 1% of the time. When we queried him about why the Federal Reserve did not put in place tougher regulations to curb the erosion of mortgage lending standards, what he said is when you see unfair lending practices, What you need is not more regulation, but more law enforcement. So we looked, and what we found is between 2000 and 2006, when our mortgage markets were radically transformed in this country, the Federal Reserve referred a whopping 3 cases to the Department of Justice for unfair lending. One related to a bank in Carpentersville, Illinois, one related to a bank in Victorville, California, and one related to the New York branch of Societe Generale. The fact is, the warning signs were there. Policymakers chose not to act. Secondly, and related to this chief finding of avoidability, was the dramatic and widespread failures in financial regulation. Not only the gaps that had grown up in our financial regulatory system as our financial markets had radically and dramatically evolved over the last 30 years, but the absence of regulators in using the authorities they had to curb excesses in the market. And of course, this phenomena was in no small part due to 30 years of deregulatory ideology that had spanned both parties and ultimately had commanded the financial marketplace and financial public policy. There had come to be a belief that somehow the financial industry had learned to manage risks such that you did not need the level of public oversight that previously existed, and that also somehow there was a correlation between the self-preservation instincts of financial institutions and the greater public interest. And we know today now that that was a deeply flawed ideology. So if you look at our report, you will see instance after instance where authority existed, but those charged with oversight did not act. The Securities and Exchange Commission had all the power in the world that they needed to curb the excesses at Goldman Sachs and Merrill Lynch and Lehman Brothers and Bear Stearns, and they did not. The Federal Reserve Bank of New York, led by Tim Geithner at the time, had the ability to crack down on the excesses that were occurring in institutions like Citigroup, but it did not. And time again, we saw these failures that emanated out of this larger ideological shift. Thirdly, and again related to the failure of oversight, we saw dramatic breakdowns in corporate governance and reckless activities, knowing and unknowing, at major financial institutions, systemically important institutions in this country. And again, our report is replete with very dramatic examples of how large, systemically important institutions took outsized bets to the detriment of the larger financial system. When you look at our report, you can read about how at AIG, they took $80 billion of bets, credit default swaps, on subprime mortgage securities. And at the time they did it, their CEO, who was paid $107 million, I think, over a short period of 3 years, their chief financial officer, their chief risk officer, none of the leading officials of that company had any idea, according to their sworn testimony, that they would be required to post collateral billions of dollars if, in fact, the market value of the subprime securities that they were backing began to decline. You'll read about how at Fannie Mae and Freddie Mac, how in 2005, 2006, 2007, being outcompeted, out-hustled by Wall Street, who had commanded the subprime mortgage lending market, how they reversed course and began to dramatically pursue that marketplace in the quest of bigger market share, profits, and bonuses for their executives. And you'll read about how at Merrill Lynch and Citigroup, these behemoth institutions, each of them took losses in 2007 of about $50 billion a year from bets and collateralized debt obligations that, again, their own management said of which they had no knowledge. Fourth, we found that throughout the whole financial system, there were levels of excessive borrowing and risk and leverage and a lack of transparency that ultimately led to this financial implosion. And I think central to that is a recognition that by 2008, our financial markets had dramatically transformed from the post-depression construct of a regulated system of commercial and bank institutions across this country. By the eve of the crisis, the shadow banking system, the lightly regulated, relatively opaque financial system, had grown to $13 trillion in size, bigger than our regular banking system. The leverage ratios at major financial institutions had hit 40 to 1. For every $1 of capital, they were borrowing $40. At Fannie Mae and Freddie Mac, it was 75 to 1. So all it took was a 1 or a 2 or a 3% decline in values for these institutions to be wiped out. And it's quite striking today as we've read about the fall of MF Global. Once again, how little has changed. 3 years after the crisis, a major financial institution goes down with 40-to-1 leverage. Fifth, we found that, and this is related to our first finding about really the failure of policymakers to see the crisis coming, we found that as the crisis began to unfold in 2007, that the folks we most depended on, the Department of the Treasury under Hank Paulson, the Federal Reserve under Ben Bernanke, and the Federal Reserve Bank of New York under Tim Geithner, were ill prepared for this crisis, that their lack of knowledge about the financial system that they oversaw and the risks inherent in them crippled their ability to respond crisply and cleanly to the emerging crisis. We heard all through 2007 about how the crisis would be contained. And in fact, in June 2007, when one of the first explosions happens in the marketplace, a Bear Stearns hedge fund heavily invested in subprime mortgage-backed securities blows up. The Federal Reserve, after a two-day meeting, walks away and says that what has happened there is relatively unique. It's only 4 weeks before the implosion at Lehman Brothers that the Federal Reserve Bank of New York even begins to ask the questions about who are the derivative counterparties to Lehman Brothers should they go down. The lack of knowledge about the evolving financial construct by our policymakers was truly appalling. And fifth and finally, in an area in which Bill Black is quite an expert, we sadly saw and documented systemic breaches of ethics and accountability at all levels in the run-up to the crisis. Lenders and mortgage brokers who deliberately steered borrowers into mortgages they could not afford. Firms like Countrywide that made loans that they knew that borrowers could not afford. Chris Seifer found a whole set of correspondence within Countrywide in which the CEO, Angelo Mazzillo, talks about these pay option arm loans, the negative amortizing loans, and refers to the possibility in, I believe, 2005 that these loans can bring financial and reputational catastrophe to their company, yet they kept on going. We saw the number of suspicious activity reports, which are reports of mortgage fraud, climb 20 times from 1996 to 2005, and then double again between 2005 and 2009, with the reports of about $1 trillion in fraudulent loans made from 2005 to 2007 that left us with about $112 billion of losses directly attributable to fraud in the marketplace. And finally, we saw striking new evidence of major financial institutions that were buying loans, packaging them, selling them to investors, yet not disclosing the information they knew about how defective those loans were to the marketplace. We hope in our report that we have laid out accountability, responsibility, and again, I said, a clear history of what happened. In looking back, the question is, well, who caused this? Who's responsible? I will say this. I don't think it's fair to say that everyone was involved, nor were there a few bad actors. But it's very clear in the end that the chief responsibility must lie with the folks who led our public financial system and who were the CEOs and the leaders of the companies who helped lead our country over the financial abyss. I was talking to someone earlier tonight who was talking about the information we made available, and one thing I'd like to urge everyone to do or encourage everyone to do at some point or over a series of points is to go to the website we have, because we tried to create a legacy report here. That's not just our report, but also thousands of documents, hundreds of interviews that can be studied for years to come. And you can find that at fcic.law.stanford.edu. You can also just type in the Financial Crisis Inquiry Commission and get there. So the question is, given everything that has happened, where are we today? And let me make these observations. In many respects, the financial system that was in place before 2008 is in many respects largely unchanged, particularly with respect to the largest too big to fail institutions in this country. Most of the reforms which were enacted as part of the Dodd-Frank bill in 2010 have yet to be put into effect, and there is a full-scale rearguard action taking place every day by the most powerful moneyed interests in this country to stop the implementation of those reforms, which in many respects don't go as far as they need to go. 3 years after the crash, we still don't have transparency and regulation of the $600 trillion over-the-counter derivatives market. We don't know today which American financial institutions are exposed to European debt and in what fashion. There are educated guesses that the exposure of American financial institutions may be between $150 and $700 billion, but thanks to Phil Gramm and Larry Summers and others, and the Commodities Future Modernization Act, these beautiful names, in 2000, in which derivatives were deregulated, still today, we don't know the risk inherent in that market. The credit rating agencies, which were an essential cog in the wheel of financial destruction, are largely unchanged from before their crisis. There's a recent study out showing a clear correlation between how much they get paid for ratings and the nature of the ratings. Stunningly, and not so stunningly actually, municipal ratings or sovereign debt who pay the least tend to be rated the most harshly. Corporations that pay the next amount tend to be rated less harshly, and structured products, which were the mortgage-backed securities that were at the center of this crisis, of course, pay the largest fees and are most generously rated. And the fact is that there is greater concentration of assets and power in fewer systemically important financial institutions than there were on the eve of the crisis. As of earlier this year, the top 10 U.S. banks controlled 77% of the banking assets in this country. Those banks last year, I might add, made $62 billion, and compensation at publicly traded Wall Street firms hit a record high of $135 billion in 2010. But notwithstanding this tremendous resistance to change, notwithstanding the extant risk still in the system, the Wall Street lobby, the financial sector lobby, is hard at work each and every day with 3,000 lobbyists on Capitol Hill at the regulatory agencies doing everything they can to stop reform. In the first quarter of this year, the major Wall Street firms spent $52 million in 1 quarter on lobbying, more than they spent when the Dodd-Frank bill was going through. There have been consistent efforts by congressional Republicans to slash the budget of the Securities and Exchange Commission. And by the way, this isn't a budgetary move, because the Securities and Exchange Commission brings in more in fees than it spends on its entire budget. So cutting its budget doesn't save the U.S. Treasury one dime. There have been consistent efforts to slice away about a third of the budget of the Commodities Future Trading Commission that has this Herculean task of bringing the derivatives market into the open. And of course, 44 of 47 Senate Republicans have vowed to block any nominee to the position to head the Consumer Financial Protection Bureau. But as if that was not enough, there is now a full-scale counteroffensive underway to rewrite the history of the crisis. Alan Greenspan, who I think in many respects more than anyone led this nation down the path of financial disaster, recently blamed the slow recovery, the nature of our economy, not on the financial collapse which we'd endured, but rather on, quote, he said government activism is hampering what should be a broad-based, robust economic recovery. And he decried, ironically, the frenetic pace of new financial regulations and the current anything-goes regulatory ethos. And let me just say this is quite something. This is the man who drove us over the cliff, and now he offers us driving lessons. And just the other day, someone you would think as learned as Michael Bloomberg spoke out about the cause of the crisis and laid it at the feet, surprise, surprise, of the Community Reinvestment Act and Fannie Mae and Freddie Mac and the U.S. Congress. Either he's extraordinarily ignorant, or it is, again, part of a concerted effort to deflect attention away from the true causes of the crisis. And if you look at the statements of every major Republican candidate, they too are deflecting attention away from what drove this country into its current condition. So first of all, little change. Secondly, an active effort to rewrite history. Thirdly, crushing debt coming out of this crisis that is inhibiting our ability to lift off this economy again and get it to be productive and to see real growth in this country. We read each and every day about the debt loads that are crushing the economies of Greece and Spain and Italy, countries across the Atlantic. But here at home, our recovery is being crushed by the enormous amount of debt that was left behind by virtue of this crisis. Now, much of the center of public policy debate in this country has been about the long-term debt of this country, but let's not be unclear about why we have immediate deficits today. There was the small matter of 2 wars, 2 major tax cuts, and of the $1.4 trillion deficit that we have today, about $1 trillion directly attributable to this crisis. And if you look at the history of financial crises, they are often crises that bring on enormous private debt, then followed by public debt, part of which is to ameliorate the private debt. But in our country today, we have a crushing debt on working families in this country, and unless we deal with it, we cannot climb out of this country, this recession. Today, 11 million families owe more on their mortgages than their homes are worth. Another 2.5 million families are on the cusp of owing more. In my home state of California, 36% of the homes with mortgages are underwater. In San Bernardino County, it's 54%. Nationwide, the negative equity of homeowners, middle-class working Americans, is $700 billion. And in the state of Nevada, the aggregate amount of mortgage debt exceeds the value of homes on a statewide basis. And the fact is that the first wave of foreclosures in this country came from the extension of credit to people who probably should never have had credit extended to them on the terms that it was. The second wave came from those 9 million jobs that were lost. And the third wave of foreclosure that's going to keep our housing market in crisis are the tens of millions of people in this country who owe more on their mortgages in their homes and ultimately will begin to walk away as any rational economic decision maker would do. And finally, we're left with this in the wake of the crisis. Who would have thought that after what we've been through, we would come out of this crisis with greater and greater inequality of wealth and income in this country than before we went into it? Yesterday I was in New York and I had the opportunity to visit Occupy Wall Street, notwithstanding all the comments about how disorganized those folks are, the young people are, how they have no message. Let me say 2 things. First of all, they're extraordinarily organized. They have a library, they've got a first aid station. Their food station just got an A rating by the New York Health Department. So it's apparently a pretty nicely functioning restaurant. But more than that, they do have a message, and it's pretty simple, and it's pretty clear. And that is there's enormous income inequality in this country that is going to cripple our productive capacity for years to come. As we gather here tonight, we've got the lowest ratio of wages to GDP since the Great Depression, the longest length of average unemployment since we started keeping records in 1948. Wages have been stagnant in this country now for 14 years. And one of the most striking pieces of data that I've seen recently is how income growth is now being shared in this country. If you look back at past recessions and the recoveries, if you look in the 40s, the 50s, the 60s, the 70s, even the 80s, you see as we climbed out of recessions, about half the growth tended to go to corporate profits. About half the growth tended to go to wages. As we came out of the dot-com crash, that shifted somewhat to about 70% of the growth as we climbed out of that recession going to corporate profits and about 15% to wages. Since the recovery, in quotes, officially started in May of 2009, 92% of this nation's income growth has gone to corporate profits and 0 has gone to wages. So we stand today not just in the wake of a financial disruption, but we stand today at a place where we really do have to think about remaking, not just rebuilding our economy. Let me close with these thoughts. I went far too long, but I want to just make these observations in wrapping up. Where do we go from here? I think there are I don't want to be like Rick Perry. You know, I think there are, hold it, I think there's two, no, maybe three things. I got four here. I'm going to tell you. There are four things that we need to do. The first is the matter of justice. I made the joke today about being in a courtroom in which very few people who participate in this crisis have seen. It's probably the most often asked question I get. Why have there been no prosecutions? Why there's been no justice in the wake of this crisis? It's important that there be thorough investigations, and it's important that where there have been violations of law, there be vigorous prosecutions, not as a matter of vengeance, but to right wrongs. It's the American system of justice. It's important that that occur so that Americans have a sense that we have one justice system, not a dual justice system, one for people of wealth and power and one for everyone else. And it's critically important that there be vigorous investigations and prosecutions because of the simple matter of deterrence, making sure this does not happen again and that there are consequences for breaking the law. Time and time again, we've seen civil settlements where people settle for pennies on the dollar with no admission of wrongdoing and a promise that they won't break the law again. And let me just submit to you for a moment that if someone robbed a 7-Eleven of $1,000, could settle 5 days later for $25 with no admission of wrongdoing, I suspect they'd be back at it pretty darn quick. So this is not a matter of revenge. It's not a matter of cleaning up the books. It's about making sure this doesn't happen again. Secondly, the reforms that were enacted in 2010 have to be put in place. And in my view, they should just be the start of a larger reform effort to ensure we have a stable state financial system. Look, I come from a background of risk. I've been an entrepreneur. I've been a serial business builder. And the American capitalist system is about taking risks, getting reward. There are failures in the marketplace, but the financial system is like the heart of our system. We want stability, and we certainly want stability among the too big to fail institutions for whom we pay the price when they fail. And this consistent rearguard action that's being undertaken by the moneyed interests of this country are exposing us to the next crisis, which is the subject of this conference. Third, we need debt relief in this country. And let me just say, if you look closely at public policy since the crisis erupted in the fall of 2008, almost every major public policy action that's been taken has been to protect lenders, 100%. Now look, for bad loans, for recklessness to occur, there are two parties. One is the lender who extends credit recklessly, and the second is the borrower who takes it. Except in many respects, the borrower's not being reckless, particularly if they're being given a free option, a speculator who can, on a no down payment basis, get an option essentially to buy a home. But almost every policy effort that's being undertaken here and in Europe is to protect the lenders and the extension of credit. And the fact is there are enormous losses that are going to flow out of this financial crisis. They are going to be allocated. If they are allocated 100% to working people and businesses in this country, we will never see economic recovery. And specifically with respect to the matter of housing, the mortgages of all those homes that have been underwater, they've lost their value. They need to be written down. There needs to be principal reductions so we avoid the next wave of foreclosures and instability that will happen in this country if we do not do it. And finally, and most importantly, here's what I think we need to think about in the largest sense. If you look at what happened in our economy from 1980 to the eruption of this crisis, we saw a fundamental transformation. In 1980, 15% of the corporate profits in this country came from the financial sector. By 2003, that had reached 33%. The amount of financial debt in this country had soared. For every $100 in 1978 that was borrowed by non-financial companies, only $13 was borrowed by financial companies. By 2007, that ratio was $100 to $51. We became much more an economy about money making money, rampant speculation, than an economy that was deploying capital for the creation of wealth and enterprise and job creation. And that's our fundamental challenge. The center of our policy debate in this country should be how we remake this economy, how we deploy capital to create good wages and good jobs so we can have a broad-based recovery. When we do that, when we make the investments in education and infrastructure and technology and renewable energy, and we take the high road of economic development, we will have a chance to emerge from this crisis. I want to thank you for asking me to be here tonight, and I look forward to tomorrow's session. Thank you very, very much.